Today I will share 3 investment funds I believe every beginner should know about. Plus, I will guide you through a step-by-step process on how to blend these investments to create a portfolio. But just to be crystal clear, this is not an investment recommendation. My goal is education. I'm here to provide you with examples of how you can enter the investment world without making things overly complicated. The purpose of this video is to demonstrate that you don't need a perfect plan to start investing. You can indeed start with a small amount of money, armed with the basics and a reasonable approach. So let's dive right in. The first fund that I highly recommend for a beginner to get familiar with is the US Stock Market Index Fund. I know these names might sound a bit complex and overwhelming, but trust me, it's not as complicated as it might seem. A US Stock Market Index Fund is like a basket that holds a portion of nearly every company that's traded on the stock market in the United States. Imagine having a snapshot of the entire American business landscape, from tech giants to healthcare firms to consumer goods companies, all neatly packed into this metaphorical basket. And when you decide to invest in this fund, you are essentially spreading your money across all these different companies. So why is this particular fund such a great starting point for beginners? There are a few key reasons, and it starts with the concept of diversification. Diversification is like the secret sauce of investing, and its name says it all. It's about spreading your money across different types of companies. This way, if one company or even an entire sector doesn't perform well, the strength of other companies or sectors can offset the impact, making your overall investment more stable. Let's say, for example, that real estate companies aren't doing so well and are causing losses. But at the same time, companies in the utility sector are thriving. By having exposure to both, I won't be hit as hard by losses as I would if I had only invested in real estate. Now, if I were manually picking individual companies to invest in, I would need to be a pro at finding that balance. Because diversification isn't just about industries, it's a whole intricate process that considers things like where companies are located, how big they are, the way they do business, how long I plan to invest, and so on. It's a lot of work, which brings us to another important point. Managing funds involves a team of experts to make decisions about which company to invest in. Of course, this expertise comes at a cost, and it's the investors, that's us, who pay for it. But guess what? Index funds play by a different rulebook. They don't need that active management with a super specialized team handpicking companies for the fund. All that hard work is already done. This means that they can keep costs lower and make investing more accessible to everyone. I will recommend you to check out this video where I break down what a market index is and how it works. That's a lot to explain in this video, so watch that one if you want to know more. Moving on to the second fund every beginner should know about, which is the International Stock Market Index Fund. In simple terms, this fund allows you to invest in companies from many countries and regions around the globe. Now, why is this an important consideration? Can you guess it? It's all about diversification once again. Adding some international stocks to your investment mix gives you a chance to tap into the growth of other markets, and it reduces what we call country-specific risk. Here's the scoop. When you are only invested in your home country's market, whether that's in the United States or anywhere else, your hard-earned money is exposed to all sorts of economic and political happenings there. Think political changes, currency devaluation, legal tweaks, you name it. But when you diversify internationally, you are spreading out that risk. Translation: if one country hits a rough patch, investments in other countries may not be affected in the same way. Here's the thing: while the US is a significant player in the global economy, it's just one slice of the entire economic pie. It's important to recognize that innovation and economic progress aren't confined to one specific country. There might be industries and technologies that are flourishing in other corners of the world, and the beauty of an international stock fund is that it does the heavy lifting for you. Now, if you are curious to know which companies are part of this fund, in just a moment, I will walk you through the step-by-step to figure that out. Because there's still one more investment that every beginner should know about, and that is the Total US Bond Index Fund. Imagine this fund as a safety net for your investment portfolio. Bonds, unlike stocks, represent loans you make to the government or corporations. When you invest in bonds, you are essentially lending money with the promise of getting it back along with interest. I sound like a broken record right now because I say this all the time. Now, why is this fund a game changer? It's all about stability and income. Bonds offer you regular interest payments, which can be a reliable source of income, and is very important during times when the stock market might be going through a rocky phase. Speaking of a rocky phase, you have probably heard many times of stock markets being compared to a roller coaster, swinging up and down like crazy. Why are bonds not included in that comparison? Because they tend to be more stable and predictable. Imagine your investment portfolio as a seesaw. We usually expect that when the stock side goes up, the bond side goes down, and when the stock side goes down, the bond side goes up. This seesaw effect is what can help stabilize your portfolio's overall value, making the ride a bit smoother and less nerve-wracking. And no, investing in bonds won't make you rich. They do not offer the same dazzling returns as stocks, especially here in the United States, where interest is most of the time very low. What bonds do is that they bring a different kind of value to the table. They bring reliability, income, and a helping hand when the market gets a bit too rowdy. So if you're looking for a well-rounded investment strategy, including the Total US Bond Market Index Fund might just be the cherry on top. Now that I have revealed the 3 must-know investments for beginners, let's dive into how you can seamlessly combine these very funds to create a solid portfolio. First things first, you will need an investment account. The type of account depends mainly on your investment goals. If you are eyeing retirement, a 401k or a IRA could be your go-to, especially for the tax perks they offer. But if you're not aiming for those benefits, a regular brokerage account might be your ticket. Next up is selecting the funds. In this video, we are talking about the US Stock Market Fund, the International Stock Fund, and the US Bond Fund. However, to make it all happen, you need to know the tickers that represent these funds, as there are many versions out there. Lucky for you, I have got those stickers right here on the screen for the 3 main investment giants. Feel free to pause the video to take a screenshot. But here goes a tip. Whenever you are investing in a fund, make sure to double check what it's made of, what the cost of investing is, and whether it aligns with your preferences. So now that you have got your account locked in and the fund tickers are ready, let's move on to the next task, which is determining your allocation. Allocation in a nutshell, it's about asking yourself, how would you split up $100? How much of it would go into domestic stocks? How much would go into international stocks? And how much gets parked in bonds? The answer to that question will be based on your risk tolerance, experience, time horizon, and goals. But what I will do to make it even easier for you is I will toss in a link to a quiz from Vanguard. Answer the questions and it will suggest an allocation that fits your risk profile. Let's say it gives you a 60-40 split, which by the way, it's a pretty popular starting point. 60% for stocks, 40% for bonds. From there, you just tweak the 60% between domestic and international stocks. A common strategy for moderate risk takers is 42 in American stocks, 18% in international stock, and 40% in bonds. But of course, the whole purpose of this is for you to jazz it up and suit your taste. Oh, and here's a golden rule. Remember to rebalance your portfolio at least once a year. As time rolls on, your fund performance might throw your allocation off balance. It happens all the time. For instance, if you started at 60% in stocks and 40% in bonds, but a year later you are at 70% in stocks and 30% in bonds, no need to sweat. All you gotta do is buy more of the underrepresented asset, which in this case are bonds, until it goes back to your preferred balance allocation of 60-40. There is no need to sell any stock. Got it? Give it a try, and remember, the key to successful investing is getting started and staying consistent. If you found this video helpful, please give it a thumbs up and subscribe to the channel. Thanks for watching and see you next time. Bye!